Today, we're talking about Dr. William's tax-free retirement plan. Hi, I'm Laurent Munier from Safe Pacific Financial, and we help Canadian professionals and business owners to grow, protect, and pass on their wealth strategically and tax efficiently. Today, I want to share a real-life success story about one of our clients. He's a physician who's completely transformed his financial outlook using one of our advanced planning strategies. If you're earning a high income and you're maxing out your RRSP and your TFSA, you're still frustrated with taxes eating away at your investment gains, this approach could make a huge difference, just like it did for Dr. William. This is the real financial challenge that faces high-income Canadians, right? Many high-income professionals in Canada, especially doctors, dentists, lawyers, or incorporated business owners generally, the challenge isn't making the money. The challenge is keeping it and growing it tax efficiently and passing it on to the next generation without giving half of it to Ottawa. So our friend Dr. William, for example, he's a successful physician who's got a busy medical practice, earning a substantial income, and had done all of the right things on the service. Basically did everything that you're supposed to do. He's incorporated, he's got retained earnings inside the company, and he was investing the surplus cash. But like many other high-earning Canadians, he soon realized that earning a high income also comes with very important financial challenges. And here's what he was up against: excess corporate cash with no tax-efficient home to put it in. So he had accumulated significant retained earnings in the corporation, but didn't have a clear strategy for what to do with those funds. You keep them in corporate checking account, that means you earn next to nothing. You invest them inside the corporation, and then you've got the punishing passive income taxes. You know, your investment income that's inside the corporation is taxed up to 50% in Canada. So many incorporated professionals don't really realize that the passive investment income inside your corporation is often taxed at the highest marginal tax rate in Canada, so up to 50% depending on your province. So that means nearly half of every dollar that you earn from your corporate investment goes straight to the CRA. That goes to Ottawa, and it lets bureaucrats in Ottawa decide what to do with your money versus you keep your money and you could decide what to do with your money. Most of our clients appreciate deciding what to do with their own money versus sending it halfway across the country to, I don't even know what happens over there. Another thing is that you could lose your small business deduction. So Dr. William was also at risk of this, so he could lose his small business deduction. So in Canada, once your corporation earns more than $50,000 passively, you start to erode your small business deduction. And you're eroding it at a 5-to-1 ratio. So for every $1 that you make extra, $5 comes off your small business deduction. It's kind of wild. So this could end up with an additional 13% tax on his active business income. And that's serious, right? Like, what do you have to do to earn 13%? Quite a lot. So just getting taxed an extra 13% is expensive. He also had no clear estate plan, and he didn't really have a legacy plan set up. So he was thinking about the future and specifically what kind of financial legacy that he's going to leave for his children, but there was no plan in place, and he had concerns about estate taxes and probate. So he needed a way to ensure that the wealth would transfer to his family in the most tax-efficient way. He also wanted to have long-term financial security. So he grew up in a family, they weren't rich, right? Money was uncertain. And so he wanted to do something different for his own family. He wanted stability, it was really important, predictability, and peace of mind. These are values that we talked about and that he really was stressing. So he wasn't just looking for the highest return. He wanted a smart, tax-efficient strategy to protect and grow the wealth over the long term. Now, is that familiar to you? Probably. If you're an incorporated business professional or you own a company here in Canada, you're probably dealing with similar concerns. High tax, especially high tax on your excess corporate cash. And then you've got an estate plan worry, right? These are some of the most common pain points that we hear from our clients and that we can help solve for clients at Safe Pacific. And so why was traditional financial planning not enough for Dr. William? So like many high-income incorporated professionals in Canada, he'd already taken the standard financial planning steps that most advisors recommend. So on paper, the financial setup was solid. He'd max out his RRSP to reduce his personal tax burden and to save for an eventual retirement. His TFSA contributions were up to date, and this allowed for some tax-free growth. But really, like, your TFSA is sort of limited, and the amount that he was earning, it didn't really make a huge difference. But, max out your TFSA, it's important. And he'd invested in real estate. So he owned a couple of rental properties that were generating a little bit of passive income, but they were growing with long-term equity. And then his company, itself, the medical practice, is thriving. He's got a steady stream of income, and that is growing the retained earnings inside his professional corporation. But even with all these pieces in place, it wasn't all the way right. So he realized that he was still losing tens of thousands of dollars each year to tax, especially on the passive income side, the passive income that was inside his corporation. His money wasn't working as hard as it could, and there was no integrated long-term financial strategy that tied everything together. He wasn't looking for just random investment advice or another tax shelter. He wanted a high-level, tax-efficient wealth plan that was designed specifically for his situation, an incorporated professional in Canada. And then that's why he called us. So we specialize in working with incorporated professionals of all types: doctors, dentists, lawyers, software developers, consultants, and just general types of professional business owners. So these are the people who've done the basics, and they're looking to take the financial strategy to the next level. They want to go beyond traditional financial planning and into the more advanced tax-optimized wealth solutions. So we showed him a better way. A financial strategy that was designed specifically for high-income incorporated professionals that prioritizes tax efficiency, corporate cash flow, asset protection, and then an eventual estate plan. So it's not a one-size-fits-all approach. It's a customized, future-focused strategy that's built specifically around his unique goals, his lifestyle, his legacy, and it made a huge difference, right? Now, what did we do? How did we structure this tax-efficient wealth plan for our boy, Dr. William? So at Safe Pacific, we specialize in helping high-income Canadians turn their corporate earnings into a long-term tax-efficient wealth. So, like I said, he's a successful incorporated physician, and he came to us with that goal. Here's how we helped him to implement this powerful financial strategy that's tailored specifically for incorporated professionals. So number one, we redirected his retained earnings from his professional corporation. So money that was previously sitting idle in the corporation and taxed heavily, we actually opened up a special kind of life insurance policy that's called a participating whole life insurance policy. And the policy was designed, of course, to provide the insurance coverage, but also to function as a high-performance tax advantage financial asset. So you can build a lot of cash value inside these policies, and that cash value will grow from a dividend that gets added to the policy every year. And all of that growth is tax deferred unless you withdraw the money. But then the way that we showed him how to use it, you don't actually withdraw the money and that tax never happens. So secondly, once that policy is in place, the policy begins to accumulate this cash value. And unlike traditional investments, the cash value is shielded from market volatility. And it grows steadily over time. That's powered by the dividend from the insurance company's participating account. Number three, he could access the capital easily and tax efficiently. So instead of selling assets and triggering capital gains, he can actually leverage this policy using either a tax-free policy loan or a tax-free collateral loan from a bank. These loans give liquidity for future opportunities. So that could be for real estate or for expanding his practice or for his personal use without disrupting the investment portfolio or incurring tax consequences. And then really the most important part was it was structured to provide a significant tax-free death benefit to his family. So life insurance in Canada would bypass probate. It pays out tax-free if you set it up correctly, which is how we showed him how to do it. So the CRA doesn't get all involved in it. And it ensures that his children will inherit a clean and predictable and protected transfer of wealth. So it's more than just life insurance. It was a strategic financial vehicle that was built for the long-term tax planning, for intergenerational wealth transfer, and for financial security. And by using this corporately, by putting this whole life insurance inside the corporation, he turned his idle capital into stable, private, tax-sheltered financial asset that gives him both peace of mind and a powerful legacy play. And so what are the results? He's got tax-sheltered growth, liquidity, and a tax-free legacy. So by implementing this carefully structured wealth strategy, he achieved far more than just a life insurance policy. He created a comprehensive, tax-efficient plan that supports his long-term financial goals and his family legacy. So he unlocked a new stream of stable, tax-sheltered growth by redirecting the retained earnings from the corporation into a participating whole life policy. So unlike traditional corporate investments that are taxed at, 50%, the cash value inside the policy grows tax-deferred, and it compounds quietly and predictably year after year in the background. He secured guaranteed access to the capital through these policy loans or collateral loans, which gives him the liquidity that he needs for future business opportunities or real estate deals or emergency funding for something without needing to sell assets or trigger capital gains. This is really valuable for incorporated professionals who want the flexibility without compromising growth. He also is not subject to the passive income rules that we talked about earlier because the life insurance is tax exempt. It doesn't actually, the growth inside the insurance policy doesn't count towards the passive income rules, so it doesn't affect his small business tax rate. And then lastly, he established a tax-free legacy for his family. So the death benefit from the whole life policy is paid out tax-free. It doesn't go through probate. It avoids CRA involvement, and it ensures the children receive a clean, seamless transfer of wealth with no hidden fees, no surprises, just clarity and control. And he got what he wanted, right? He got peace of mind with a personalized strategy that is aligned with his values. So as someone who grew up around financial uncertainty, he wanted to ensure financial stability for his family. So with this plan in place, he knows that his hard-earned wealth is protected, it's growing, and it's ready to support his current goals, his retirement goals in the future, and his legacy goals in the future. So this isn't just about insurance. It's about an intelligent financial architecture, a system that's designed to reduce the tax drag, preserve your capital, and protect intergenerational wealth for your family. And so at Safe Pacific, this is what we do. We believe that every incorporated professional in Canada deserves this level of clarity, confidence, and control over their financial future. Now, could this work for you? I don't know. We've never met. So this type of advanced wealth planning for high-income Canadians, it's, if that's you, if you're a high-income Canadian business owner or you're an incorporated professional, successful entrepreneur, this tax-efficient strategy might be the missing link in your financial plan. So we have worked with hundreds of Canadians that are like you, that are looking for smart, conservative ways to grow and protect their wealth without losing half the money to Ottawa. So this works really well for doctors of all types, physicians, surgeons, all different types of specialties that are looking to shelter the retained earnings and create tax-free retirement incomes in the future. Similarly, dentists. For the same reasons, doctors and dentists are kind of in the same category. They want that reliable alternative to market-based fluctuations, but they also need the tax protection. Lawyers. Lawyers is actually one of the client types that we have the most of. So when we can filter by profession in our CRM, our number one type of people that we work with are lawyers. So they fully understand these things because insurance is a contract, and lawyers can generally read the contract and say, that makes sense, I like it. But they also want the asset protection, the estate planning that's built into the financial strategy. We've got tons of engineers. So engineers are really special to work with because they want to see all the numbers. They want us to send the Excel spreadsheet so that they can break it and put it back together. And that's fine. We love doing that. We love working with engineers because we know that after you've gone through it and you broke it and put it back together, that you get it. And then that is better for you and it's better for us. Engineers really like these types of structures, especially when they're looking for that long-term stability. And then entrepreneurs. So business owners, entrepreneurs who want to get the value from the corporation while safeguarding their family's future. And then also, especially the entrepreneurs that understand the way that they're going to make the most amount of money is by doing whatever they do. So whether you're a consultant or a plumber or a contractor or a developer or whatever, that's the way that you're probably going to make the most amount of money, is by doing that thing. And so we like the entrepreneurs that trust us to say, okay, well, you made the money, give it to us over here. We'll make sure you don't lose it. Go make more. And we'll make sure that when you've got it, that you get to keep it. So if you've accumulated these types of retained earnings in a corporation and you feel like you're paying way too much in tax, or you just simply want a better way to structure your investments for today, you want to invest, tomorrow you want to retire, and then tomorrow, there's eventually going to be an estate planning need when you're not here anymore, and you want this to go to your whoever you want it to go to. Generally, people want it to go to their family and kids. This is what we specialize in. We specialize in creating custom, tax-efficient, insurance-based strategies that align with your income, with your risk tolerance, with your long-term goals. And, whether that's you're in growth mode or whether you're preparing to exit the business or whether you just had an exit and you've got a big chunk of cash right now and you want to make sure that you keep it, we can help you build that strategy, and we can help build it around your values, based around what do you want to do, and really based around putting you in a lot of control over how that works. So if this sounds, Dr. Williams' situation sounds like something that that you want to look at, we might be able to help you. So how do you do that? Number one, go to our website. On our website, there are tons of buttons where you can click and contact us. Some of them you can send us a message. Some of them you can book a meeting directly in our calendar. Up to you, you choose. I'm not going to pressure you to do one or the other, but you go to our website. It's safepacific.com and fill out the form there or set up a meeting there. Somebody on the team will get back to you quickly, and we'll set up a free, no obligation consultation to learn about your situation and to explore whether this strategy is right for you. And if it's not right for you, we will tell you. We're not trying to sell anything to anybody. And we definitely don't want somebody who shouldn't be a client to be a client, because that's no good for anybody. Now, before we go, if you found this video helpful, please share it. Click the like button, click the subscribe button. If you got any questions, leave a comment below, because this video is really for only specific people and there's not a lot of them in Canada. So by doing these things like, share, comment, subscribe, it helps to spread the video to more people who are like you, that are harder to find because there's not a lot of people like you. Anyways, that's it for me today. I will see you next time.